This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go! Hello, and welcome back to the Fintech Takes podcast. My name is Alex Johnson, and this is another edition of Bank Nerd Corner. So, we are thrilled to be joined by our absolute favorite banking and fintech editor, Kiah Haslett. Kiah, hello.
Hey, Alex, how are you? How was the basketball game and the other stuff that happened in Las Vegas?
Oh my gosh. Well, I mean, as you know, I can't tell you everything that happened in Las Vegas, but I will say that, and actually really nothing happened, but I will say that the basketball game was super fun. There are really good athletes working in fintech. There are
overachiever types.
Yeah, there's like annoyingly young, in shape people in fintech. There are people who sort of sandbagged about how good they are at basketball in fintech, but they're all very nice and very good competitors, good sports.
Good.
We refereed ourselves. We called our own fouls. Didn't have to, I brought a whistle in case I needed to play the role of referee, but I didn't. So
you didn't want to be the person who had to impose order at the pickup basketball game.
Yeah, I really didn't, and my only thing was like, if you cross me up or like make me fall or anything, I'll write bad things about you in the newsletter. Mm-hmm. So people took it easy on me, which was nice.
Yep.
And, most importantly, everyone walked away with full health. We were all very tired at the end, but like there were no sprained ankles or torn MCLs or anything like that. So it was, despite us not all being in terrific shape, we had a lot of fun and we were able to avoid major injuries. So that was definitely the highlight. The rest of Vegas was just, money 2020. It's you and your, I don't know how many people were there, 15,000 closest friends in fintech. It's a lot of people. I have a disturbingly detailed knowledge of the Venetian and Palazzo hotels now.
Mm-hmm. Congrats.
And now Treasure Island, which I was the hotel of choice this year, which is not my favorite hotel, but, trying to be fiscally responsible. So that was good. And, the content and the discussions were all really good. I won't belabor it because I've written and podcasted about that elsewhere, but a couple of the topics we have on our agenda today will be ones that definitely heard about at the show. So, no, it was good. How was your event? What event did you go to again? Remind us.
So again, it was the Federal Reserve Bank of St. Louis, their community bank conference that's held in conjunction with the Conference of State Bank Supervisors.
Yes.
And it was fun. I did all my homework ahead of time and read the papers, so I didn't have to, they present the papers, but I'd already kind of read them and I was familiar with them.
Kiah always does her reading ahead of time. You should see the level of prep she puts in for this podcast. I mean, it's obvious, but
what am I going to tweet about at 11 p.m. if it's not these accounting and research papers?
Exactly. Yeah, I get text messages from you late at night going like, hey, you should read this. I think
I wish I could schedule send my text messages because I schedule send my emails.
Yeah.
And I can schedule send my Slacks and make people think that I'm a
normal
industrious
person.
Morning bird.
Yeah.
But in fact, I'm a night owl reading bank stuff that late at night, and I can't, the tweet or the text you can't hide. And then, I think I do some of my best tweeting at 11 p.m.
Totally agree.
But my bank nerd accomplishment was that I got to say hello to Fed Governor Michelle Bowman.
Nice.
And because I've never met her before and she's never met me before, the only thing I could really think to say in that moment was, I'm a really big fan of your speeches. I think is, I feel like that's how I'm familiar with her work, but her work is speeches.
Yeah.
And the statements. And so
how did she react to that?
I think she was really honored, but I think how would you react to someone saying I really like your speeches?
I don't know.
Weird.
Yeah.
But I also shared with her that I wrote, basically one of her speeches about competition in bank M&A led me to be a little bit more curious about how that's kind of calculated. And I wrote an entire magazine article, which is even kind of weirder to tell a Fed governor that you wrote an entire magazine article based on one of her speeches.
Yeah.
But then the next day, she asked me what I thought about her speech. And I was like, I think you said some really interesting things about uninsured deposits. And I'm really excited to see what comes out of the FDIC and the Federal Reserve about uninsured deposit liquidity risks.
Wow.
Real nerdy stuff.
Yeah, you got to nerd out with one of your, Michelle Bowman has come up on this podcast before, so getting to meet her in person, that's a pretty big deal. No, that is very cool.
I tried not to fangirl, and I don't think I successfully did it, and I possibly did it in the weirdest way possible.
Oh, that's really funny. Well, I had several similar experiences of getting to meet people in person for the first time, and I was like, I'm a big fan, so it was there's definitely an element of that with all in-person stuff. I think especially when we're so remote, like by default these days, that like when you get to meet someone that you've wanted to meet for a long time in person, it's extra special, I feel like.
Yeah, I totally agree. And I felt like I'm not like a policymaker. Like we weren't like at a round table where I got to be like, here's everything I know about banks. I was just like, hi, I'm a person. I really like your speeches.
I'm a human. I'm a fan. Well, I mean, she probably doesn't get that as much as,
She should get it more, but if she doesn't get it enough, I'm glad I could do it.
Well, she does say interesting stuff relative to many other folks in the policymaking arena. I always find her comments to be comprehensible and like really like pointed and trying to like, establish a viewpoint. So I probably would have fanboyed out a little bit myself if I had seen her, although probably not nearly as much as you. So you were the right person to go at that conference.
Well, I wanted to pitch a couple of topics to you. Hopefully we will both have more topics this time around and not go on for 40, an hour 15.
Yeah.
Okay, Alex, my first topic for you was, did you have debit interchange on your 2023 regulation bingo card?
I didn't, because I think I was more focused on like Durbin 2.0 credit card stuff.
Credit cards, yeah.
Yeah, I was more kind of credit card interchange focused. Debit interchange, I thought we were kind of settled on, but I guess not.
Yeah. Yeah, so you are referring to the proposed congressional...
I am, yes.
Law, or I guess that's what Congress does, around debit or credit interchange.
Yeah, like they're working on credit interchange, but like, the state of Congress is such that anything that's like happening in Congress right now, you're like, okay, I can probably wait till like 10 years from now for this to actually turn into a thing that actually happens, because it's not very productive these days. So I think I just kind of written off in 2023 that anything was going to happen, but something may be happening. Tell us what's going on.
Something may be happening. Yeah. So in late October, the Federal Reserve released a proposal to lower the maximum interchange fee that large debit card issuers can receive for debit card transactions. And then subsequently, they want to establish a regular process for updating the maximum amount every other year going forward. So and you'll recall that, the first and last time they did this was in 2011 via the Durbin Amendment, where they basically, cap debit interchange income for large banks, which was defined as $10 billion. And, a lot has been written about every single thing that happened as a result of that debit interchange cap. And I think this is a really interesting that they've decided to revisit this and have decided basically like the cap or the number is still too high between 2011 and 2023. So, $88 billion of payments were processed on debit cards in 2021. This payment type has the highest rate of dollar payment growth relative to every other form of payment available to consumers. And then the Wall Street Journal reported that banks subject to the cap received $16.6 billion of these fees in 2022. So this is the amount of money that they might get less of. And so, there's this whole like kind of calculation that goes into the debit interchange cap. And the board has the authority to adjust the cap based on what's reasonably necessary to make the allowance for costs incurred by debit card issuers and in preventing fraud that's related to debit card transactions that the issuer might bear.
Yeah.
In 2021, the Fed reported that transaction processing costs of the average debit card transaction had declined by 50% between 2009 and 21, from 7.7 cents per transaction to 3.9 cents. And, you know, I think there's like, you know, the joke here is that similar to how productive people get more work, efficient processors get their fees reduced.
Yeah.
I think when I'm, you know, kind of maybe, and I always start these podcasts by saying, this is my own opinion. I'm just a reporter who has some opinions. But
these are facts delivered by Kiah Haslett from on high.
Well, I mean, this is a real opinion right over here, but that it almost seems like the Fed doesn't really think this should be a place where banks make money.
Yeah.
That this is more of like a service that's provided and is provided for free, rather than banks shouldn't have incentives to make money around this, and they shouldn't be trying to, every time they make an efficiency, that efficiency would then be reflected in the cost that might be changing every 2 years. And so what this, you know, how the formula would change is that a $50 debit transaction would decline from 24.5 cents that the issuer would get to 17.7 cents under the proposal. And then the Fed actually writes this with, as far as I can tell, a straight face, that merchants may in turn pass some of the portion of their savings of lower interchange customers.
No.
So,
They did
Alex,
not really say that, did they?
It's in there. I didn't say it verbatim, but I said the words just in a different order. So, Alex, my first question for you is, what are you planning on doing with all the savings from your interchange income that you'll be receiving if this proposal passes?
Yeah, no, I mean, it's a good question because I was actually able to put away all the savings that I need for all 3 of my kids' college funds in the future.
Oh my God.
Just based on the debit interchange savings since 2011 that I've been able to collect because merchants passed it all along to me. So I don't even know. I mean, you said what's going to go from, for a $50 transaction down from 24 cents to 17 cents. Like, I mean, I'm going to quit my job, I think. This is amazing. I'm so excited. No, obviously, I'm being facetious. I know that you were too. They don't pass the savings on, man. What?
Alex.
The one thing I
you
feel
don't
like
think since 2011 we've benefited from the savings of debit interchange? We lost free checking. We didn't get lower prices at the checkout counter.
We did not. And here's the thing, just to be totally clear about this. This was a thing we knew was going to happen before they did this. Just to be totally clear, and I'm not going to relitigate the entire Durbin Amendment and the process that led to it, but we knew at the time, based on the experience of other countries that had gone through this before us, that businesses are not in the business of giving money to their customers for free with nothing in exchange. That's not what they do. And so, yeah, no, I don't think that any of this is going to get passed on. I don't think it's at all surprising that the merchants that drive this discussion and drive everything relating to originally the Durbin Amendment and then certainly the interpretation of this requirement at the Fed, which is hilarious to me, all of it is driven by, I don't know, I think you can count on one hand the number of large merchants who really care about this and who really benefit from it and try to optimize for it. It's, everyone's favorites. It's Walmart, it's Amazon, it's Target. It's the same set of companies that are doing this. And the irony of it to me is I actually, and this is a theory I have, I don't think most even merchants really care, to be totally honest with you. I think they're fine. They find, they find interchange a little bit annoying, but they really value being able to accept debit cards and credit cards. I actually think, here's a proposal for you, Kiah. You ready?
Okay.
So imagine an alternative universe where it was credit card interchange that was capped and not debit card interchange.
Oh, I was gonna bring that up, but do not touch credit card. I agreed with you with your read of the Durbin 2.0.
Yeah.
And the less we talk about it, the better, because that would crimp just so much of my personal spending and also how I travel. It's kind of crazy that, as someone who only spends on her credit cards for reasons I've already discussed, I'm always confused that people spend so much money on debit cards, and I was shocked to read about the payment volumes.
Yeah.
It kind of makes sense that this is where they're targeting it. But my understanding is that the big credit card issuers make hand over fist money from their credit card interchange.
Yeah.
And the cards with the highest annual fees get the highest interchange from the merchant.
Yeah. No,
and so it's kind of crazy that's just been allowed to happen.
Well, yeah, I mean,
they're focused on debit.
No, I think that's true, right? And I think if the Fed was really focused on consumers, and it's always funny when I hear regulators that are more like prudential regulators talk about consumer things. It's do you really I don't know that you really know even kind of what you're talking about or have thought through this deeply. I think when we were talking about before, you were sort of framing it as they seem a little kind of incurious about the impact of this on consumers. I agree with that. They sort of toss this thing and oh, maybe consumers will also benefit from this. But I don't think they've really interrogated that idea closely because, using this sort of alternate universe framing, what we should have is we should have a payment mechanism that doesn't allow consumers to get into hideous amounts of debt, but that does come with really generous rewards funded by interchange. So imagine if debit cards, merchants had to pay a really high interchange rate for them, but debit cards are safe for consumers to use. And consumers that want to like reap massive rewards from spending without going into debt would be able to use debit cards. And I feel like the challenge with like the kind of debit card, credit card handoff is I do think there is a portion of people who are drawn to credit cards for the rewards or the perks or the other things, but their brain isn't wired in such a way where they can handle credit cards responsibly and use them like a debit card. And so those folks end up getting into trouble largely because we've sort of regulated away the ability for issuers to give rewards to debit card users, but not to credit card users. So it's it's this very weird set of incentives that we've kind of piled on each other. And yeah, no, I think this is stupid. I think your earlier point about the Fed lowering it based on the sort of lower cost of fraud, like that's crazy to me, honestly, because like the incentive is really for issuers to not care about debit card fraud, honestly.
I cut some of this out. I cut out a lot of like fractional penny math that was in the proposal. You should definitely go look it up because it does kind of include like the new breakdown of what the new interchange cap would be. And so of the like 17.7 cents on that debit interchange, like the fraud prevention portion is going from 1 cent to 1.3 cents. So in the new formula, they are slightly increasing the fraud prevention allocation, but the overall net effect is that there's just less money for issuers. Also, I mean, like the Fed wrote this with a straight face that they wrote that the proposal could generate benefits to the extent that merchants pass along savings from the lower debit card acceptance, but could also have negative effects to the extent that covered issuers increase fees associated with debit cards or deposit accounts. The net effect on consumers, both individually and in the aggregate, will depend on how these two effects predominates, which would in turn depend on many factors and is difficult to predict. And I just want to say, like, again, super, super my opinion, there's actually a lot of data, and we can like see before and after what happened in at least the bank space when this Durbin went into effect. It did not just create an entire branch of fintech. It did not just create the banking as a service industry as we experience it today. It also changed community bank M&A, which could have potentially, there's a criticism with M&A that it reduces some communities' access to financial institutions. And it incentivized banks to get bigger really, really fast at the $10 billion threshold. It destroyed free checking at big banks, which have most of our retail accounts. It increased, like for a while, there was an interest in using consumer fees like on these accounts to make up the lost interchange.
Well, and then consumers freaked out about it, and then they had to drop those fees too. And then the thing that happens is then money-making gambits get pushed into sort of less obvious places, right? Like we didn't want the $5 fee from Bank of America, but everyone's overdraft fees went up through the roof, right? I mean, there's been studies on that too, that like overdraft income increased to make up some of these differences.
Exactly. And then, it obviously totally incentivized the creation of these like very lucrative credit card rewards, which has then created, there was a Federal Reserve research paper that published in 2023 that found the use of credit card rewards at merchants is akin to an aggregate annual redistribution of $15 billion from like less educated and poor and minority shoppers who tend to use cash debit cards or not as lucrative credit cards to consumers that tend to be more educated, richer, and not minority. And so these are like knock-on effects that we can actually like pretty directly trace back to changes that happen post-Durbin Amendment and in response to lost income. And it is so sad and irritating for me to have to like even just I think that this is so incurious. Just leave it out, right? Like just pretend, like don't even say you think this is going to happen. It's not going to happen. And it also has like pretty serious effects for the institutions that this regulator directly oversees versus merchants, which this regulator should not necessarily be concerned about.
They're not responsible for that. Yeah, no, I mean, that's the thing that is kind of wild about the whole thing is the Fed, like, this is kind of a strange way to phrase it, but like, why do they care so much about this? You know what I mean? Like, I get that like they're required to periodically review this and like that's part of their like mandate, but there's lots of things they're technically required to do that they're like, oh, maybe we'll get to that next year. Like, this seems like a really weird one for them to weigh in. And kind of going back to your earlier point about didn't have this on my bingo card. Like, I don't get why in a year when bank profitability and sort of stability has been a real question mark and an area of concern for prudential regulators, that they've decided to weigh in on the side of merchants to make their lives easier and potentially sort of put more challenges on banks. Like, I am not a fan of like whatever this is. And if you're going to do it, to your point, you should be curious about what all of the impacts of it are. So anyway, big thumbs down from me, I think.
Yeah, well, I mean, watch this space for the second wave of fun unintended consequences as a result of interchange fee being reduced. Am I right?
I think so. I mean, I think the only sort of slight cheerful bit of news to this is I do think because of the original Durbin Amendment, the industry has kind of moved off of debit interchange as like, this is what we're going to hang our hats on from a revenue perspective. So even though debit is growing and obviously fintech sort of grew up in the shadow of the Durbin Amendment, even like in fintech, like debit interchange only business models are kind of not in vogue anymore. And so maybe this will have a little less of a knock-on effect just because we've all kind of moved on from this profit pool. But yeah, I'm still not a fan.
Well, what do you got for me?
Well, all right. So I promised a little bit of scuttlebutt from Money 2020. So 1033 was a big one, as you might imagine. Yes, this is the section of Dodd-Frank that gives the CFPB the authority to regulate consumer permissioned data sharing. And as listeners, I'm sure know, they came out with their proposed rules for how this is going to work. And I won't rehash all of the rules. I would say that generally speaking, it just kind of sort of sets things at kind of a table stakes level. Like it didn't necessarily, in my opinion, advance the ball really far forward in terms of like, oh, now you must do this thing that no one in the market was already doing. It more sort of codified what the best practices are and kind of the current state in the US today. So it's focused on transaction accounts, so checking accounts, other deposit accounts, credit cards, digital wallets. It excludes other types of loans, wealth management, crypto, payroll data. So it excludes a lot of stuff. And, the overwhelming mandate and the thing they keep talking about from the Bureau's perspective as kind of their core goal is they want this to increase competition in the space. And they really, I think, if they were to try to pin it on a single metric that they're looking at for how successful this will be, it's how much more portable does this make banking customers across the industry? Like how much switching of bank accounts happens, how many sort of new tools get built to make it sort of push button easy to just move your account from one bank to another. That was also very much the goal in the UK, or one of the goals in the UK when they embraced open banking. They haven't really seen a whole lot of actual switching behavior.
Yeah, it seems also kind of like a strange goal. I don't know.
It's weird. It's really weird. It's really weird. So that's like one area that I'm kind of like, okay. And then there was a lot of discussion in Vegas last week around, well, what does this mean for Kiah, which is the data aggregation company that's partially owned by some of the big banks and that has been sort of flexing its muscles, so to speak, in the space recently, or trying to. What does this mean for the Financial Data Exchange, FDX, in terms of acting as a standard-setting body? It does seem likely, I think, that FDX is going to become the standard-setting organization for open banking in the U.S. because there's really just no one else who's doing it. But there were some pretty specific requirements in the proposed rules around like what that independent standards body can and can't do. And I think that might lead to some changes in like the membership and who's on the board of FDX. I think it might lead to, FDX having to sort of change their API specification a bit for how data sharing works, because that's what they've mostly been working on is the technical specification. I think it'll be really interesting to see how this ends up getting applied to non-bank companies over $10 billion in assets in particular, or I should say over $10 billion in revenue. So there's different size requirements in terms of how big the company is and how quickly they have to comply with the new rules once they're finalized. And the biggest companies, both by asset size, so banks, and then non-banks over $10 billion a year in annual revenue, they have to comply within the first 6 months after the rule is finalized. So say that it was finalized at, let's just say December of 2024, that would mean by June of 2024, they would need to be in compliance. And that's interesting because over $10 billion in revenue, that applies to Apple, which operates a digital wallet and has a debit card and a credit card and other things. It applies to Block, owner of Cash App, which offers a digital wallet and a debit card. It would potentially apply to Walmart based on kind of what they're doing in financial services. And so, I think The CFPB probably can't wait to pick a fight with those companies because that's kind of, I think, how Rohit Chopra thinks about the world. He comes from sort of an FTC background. So I think he has a very specific sort of like anti-monopolistic, like I want to go after big tech kind of view. So how they sort of do this with Apple, how quickly Apple complies with it. Does Apple try to find ways to kind of drag its feet? I don't think Apple wants to share data, but like, especially if I was a bank, I'd be like, hey, we have to pony up our data. You need to do the same. So that'll be interesting. I know you had sort of a open question around account-to-account payments, which really wasn't part of this at all.
I don't, like I said, I think I talked a little about open banking last week, very passionately about how I use my data. I actually don't use my data to switch banks. I use my data to build my budget.
Right.
I have, when I visited South Korea last year, I got to see a little bit of their practice of open banking in the form of A-to-A payments. And basically we went to like a food market and my friend didn't have a lot of cash and most of these vendors actually didn't take card. They accepted A-to-A payments. And so my friend would open, I think South Korea maybe has like 4 sizable retail banks. She opened up her app. She just typed in someone's number at their, like on their food stall. And then she just, and she actually and the security thing was that she showed them her phone and was like, is this you? And they were like, yeah. And then she would send them the money. And, I think we kind of get some of that experience with Zelle, which is like fake open banking. And, but to see the A-to-A payments and how, I even to just think we can't really do that in the United States, or if we do it, it has to be through Zelle, which is this integration and not everyone has it. And so it was so, I think you can go in a lot of places with data. I think, the ways that I've found open banking to be the most powerful and what I would think of as kind of transformative for people's lives is this payments aspect of it. And that the openness would kind of force some interoperability. And it's kind of hard to get excited about the proposal that there is here already and to be like, okay, well, now we all just kind of have to be singing from the same songbook versus I am getting actually new capabilities that will make money move more intuitively. And I don't know. I just kind of don't. It'll just be kind of interesting to see how it pans out. But I just don't think that account switching is also a great goal. And I don't think most people switch accounts. And I don't know, to your point, in places where this functionality is enabled, that's not really how people use open banking. And if that's the point of open banking, you might not see a lot of people kind of activating these capabilities and taking advantage of them in the way that we're seeing open banking be adopted in different countries through the ease of payments.
Yeah, no, I think that's fair, right? I mean, I think that we don't see switching in the UK. And I think this idea that you can break up with your bank, which is the specific language that they use when they talk about this over at the Bureau, I don't think that is an accurate sort of reflection of how consumers interact with financial services today, right? And Ron Shevlin's done a lot of research on this over at Cornerstone Advisors, but people open more accounts. They don't close the accounts they have. And so I don't necessarily think that this is going to drive people to close accounts or necessarily switch their primary bank. And we already had, open banking that was kind of janky in some ways, but we had it. And the thing that drove people to sign up for more apps and to try things and to have a larger web of relationships with different financial services providers, those open banking things were account verification, right? So that made it way, way easier to sign up for Chime when you could just automatically connect your existing checking account, verify it, connect it to transfer money over. That friction being removed, that was a big unlock for enabling that. It's not driving switching necessarily, but it is driving a more competitive ecosystem. So I think that's interesting.
Yeah.
I also think the other thing that kind of isn't getting enough discussion is the requirement that financial services providers, data providers under this requirement have to share pricing information. I thought that was pretty interesting because pricing is one of those ones that everybody fights over in the open banking space in the absence of rules, because banks tend to think of it as, well, our pricing is proprietary. It's the output of these proprietary underwriting models that we build. We don't want our competitors to know how we price individual users because we don't want them gleaning insights into like how we do this. Like pricing is a competitive advantage. And, I know for a fact that the Bureau received comments from banks saying don't include pricing. That's not a reasonable requirement. And to the Bureau's credit, I think they did keep that in there. So you have to disclose fees, you have to disclose interest rates, you have to make that data available if the consumer wants to share it. And to me, I think the coolest thing that could come out of this, and maybe if they expand it into loans and other types of product categories, which I wish they had done this first time, but like, to me, like interest rates and pricing is the area where you could see a lot of innovation get built on top of it. Because if you have to share that information, and I, as an alternative provider, can get that information with consumer permission, then I can go out and shop on your behalf for better rates, right? And like, I think a big thing that causes people to not switch or to not chase higher interest rates or to chase lower interest rates, if we're talking about credit cards or whatever, is it's really hard for a provider to say, hey, you should switch, you should do this other thing, because they might have a hunch that you could get a better rate somewhere else, but they don't know. They can't say like, Kiah, I can save you X amount of money per year, or I can get you X amount more money per year if you do this thing. And now that you have to share pricing information and that's like in the requirement, I actually think that might drive not switching per se, but it will drive more competitive like price shopping behavior. And to me, that's one of those ones that if you're like a lower income consumer and you just, you don't have a lot of cognitive capacity for doing other things besides like taking care of your family and working, shopping and comparing prices is one of those ones that gets tossed out the window immediately. And so the idea that you could build services that would help lower income consumers shop for better prices automatically, that is appealing to me.
Yeah, I mean, I am curious to see what comes out of it. I don't know how much the world changed when this proposal dropped.
I don't think it did. I think it was more like a nerd thing for those of us who've been like waiting and waiting to see the rules. I know some like sort of public policy people who were like Christmas morning kind of thing, like when it dropped. So I think it probably isn't quite as special as that. To your point about A-to-A payments, did you see the Chase's announcement with MasterCard?
No, I did not. Tell me about it.
Yeah, this one was cool. So this one was Chase rolling out their own A-to-A payments functionality for consumers that have recurring bills. So the idea is basically like, if you are paying, whatever bill, we can enable, or, it's a merchant that has a bill that they're, charging on a recurring basis. We can enable you, the merchant, to accept payment from customers just directly from their bank account. And it's enabled by a partnership with MasterCard, which bought Finicity, which is one of the big Plaid competitors. And you may remember that when Visa tried to buy Plaid, this was exactly the kind of thing they were trying to prepare for was, hey, what if banks want to start pushing in the direction of account-to-account payments rather than running everything over the card rails? So like Visa, I think, is probably tearing their hair out seeing this partnership between MasterCard, who was allowed to buy Finicity, and Chase, who's sort of embracing account-to-account payments. So I don't know, maybe even though the rules didn't like give a full-throated endorsement to account-to-account payments and like payment initiation, maybe we'll still end up with more to account-to-account payments.
This is neither here nor there, but I don't think a lot of people use bill pay when it's enabled either like, I think on the bank side. And, speaking for myself, I don't use bill pay.
It's mostly third-party billers that you go through direct. Yeah.
Okay. So that'll be interesting. It'll be interesting to see if people use this.
Well, I mean,
this is not the account-to-account payment I was envisioning.
No. Well, no. And
oh, wow. It's easier to pay my bills? God, that's so exciting.
So do you, the one I've noticed recently is Verizon has made a big push on this in the last 2 or 3 years.
Oh, Verizon does really want you to pay from your bank account.
And they incentivize
I definitely
you to
use
do
my
it.
credit. Yeah, they do.
Yeah.
I use like a credit card that comes, obviously I use a credit card, but it has cell phone insurance. And so, but I have received pretty aggressive marketing from Verizon to use my bank account to pay stuff. I mean, I only use like my student loans and my loans for bank account payments. I don't pay any bill.
Well, in the future, they're going to want you to do even more of that. So I think that will be...
Well, in the future where they take away my credit card, they cap my credit card interchange.
Dick Durbin's coming for it.
Take away my card rewards. Yep. You can't make a single cent on any debit card swipe. I guess we will just be forced into this A-to-A world. But a lot of things are going to have to happen for me to alter my payments. Speaking of payments, can I take us way, 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 way back to checks? Have you heard of a check before? Are you familiar with this form of payment,
So
Alex?
I have this vague memory of being like 12 and my mom showing me how to write a check. And I even remember, she doesn't listen to this podcast, so I'll tell the story real quick. She would occasionally send my brother and I to the corner convenience store to get stuff because we were like big enough to go, and she'd give us a check and she wouldn't fill out the amount. So she'd sign it, but she wouldn't fill out the amount. And
oh man, a blank check.
There were times where we were like, yeah, maybe we'll grab a few extra things that she doesn't necessarily need to know about. And I remember occasionally getting the question like, so how much was it? And we're like, it was more expensive than we thought it was going to be, that kind of thing.
Inflation, Mom. You would not believe what they're charging for.
It was weird. Yeah.
I don't even know what you'd buy at a gas station.
She probably knew exactly what we were up to, but we felt pretty clever at the time. So yes, checks, a vehicle to slightly deceive your parents when they foolishly give you a blank check.
Steal money from your mom is what I hear. Yeah. So that's actually that small instance of check fraud is a really perfect segue into what I wanted to talk about, which is that checks are not dead and they are in fact vehicles of fraud.
Yeah, they are.
So I learned from your interview with Mark Gould, the Fed's chief payments executive, that in 2022, the Fed cleared $9 trillion worth of checks, trillion with a T.
That's a lot of checks.
I have
That's a lot of checks.
It's so many. It's too many checks.
Visa would definitely agree with that statement.
And so I came across this article in the Washington Post about who still uses checks. And so they looked at a survey that the Federal Reserve runs, asking Americans about their financial habits. And they found that as recently as 2021, checks make up 4% of transactions, and more than half of Americans haven't written a check in the last month. They are most commonly used in transactions of $500 or more, but even in those transactions, people only use checks about 14% of the time. Usage is more common among older Americans, like retirement age, compared to younger Americans. And then the Washington Post also found, pretty interestingly, that checks seem to be favored by individuals who identify as white, with 51% of these individuals having written a check in the last month, which was higher than other ethnicities or racial groups. The Washington Post kind of postulates that this reflects that not necessarily the bankedness of individuals who are white, but the maybe underbanked or the unbanked status of individuals who are not white, and that there may be some historical distrust of banked institutions, which is actually like kind of a bigger problem for banks and regulators because, many, like, whatever payment you're using that's not a check or is outside of the financial system is obviously like, just slightly less secure, slightly less regulated. And so there's a lot of usage of cash among some of these consumers. And then checks are more common when paying for services like contractors, charities, taxes, and landlords. And I don't know if that has to do with, processing fees, transaction processing fees for electronic payments that we've probably gotten at in the past. So anyways, I'm bringing this up because checks aren't dead, and also checks are super ripe for fraud. And check fraud is, bank director is becoming increasingly aware of bank directors telling us that they are dealing and talking about check fraud in the boardroom. And so, that kind of signifies a volume or a magnitude that is, reaching this kind of strategic level or is kind of showing up in a meaningful way in the bottom line, right? It's starting to impact results. So my colleague, Laura Alex, just wrote about how big this problem is. She found that, Regions Financial reported last quarter, they reported $82 million in check fraud, $53 million in the third quarter. And they think that fraud losses will normalize around $25 million a quarter, which is kind of crazy. Even as check volume has declined 7% between 2018 and 2021, suspicious activity reports that involve fraudulent checks are skyrocketing. They are doubling year over year. Check fraud costs about $6 a check to manage, and it can take up to, I believe, 50 to 60 days to figure out a bad check has been passed between two banks. And there is this is like a hot potato, it feels like, for banks. And it kind of depends on if the check was washed. So if the check was legitimate and then was written legitimately and then maybe washed, or if the check was fraudulent to begin with. There is a tech angle here. Fraudsters open dummy accounts at large banks and then use RDC or remote deposit to deposit a washed check so they don't have to interact with a teller. They can also take advantage of the time lag between the two, the clearing and the settlement, to, get the money and then close the account or like move the money out before the money is like recalled. And then something that like really human and like kind of upsetting to think about is I was in a peer exchange and someone said that someone getting arrested in their lobby is for passing a bad check is a weekly occurrence. Wow. And what happens is that these like gangs that are stealing checks, like in his case, his bank, these are stolen checks. They are finding people who are unhoused and they're like kind of like cleaning them up and sprucing them up and giving them like a haircut and then giving them fake credentials, and then they go into these banks to try to cash the check. And then that is the person who gets arrested in the lobby. And it just felt like so sad. And I just can't imagine this happening on a weekly basis. Like this is a crime with victims. And I am kind of fascinated that this payment method that persists in a lot of ways that I think we were just kind of moving away from and is so vulnerable. And also banks are just doing it, and I don't know kind of what banks can kind of do to just be like, we should be trying to move every single person away from issuing checks. Yeah. But I just wanted to bring that to you because I think it's kind of crazy. It seems so antiquated that in 23 we're talking about checks, but in this way that it's like causing a lot of losses for banks. And so do you have any thoughts on how tech can solve this problem?
Well, I mean, we need to stop writing so many checks. I mean, it was interesting, right? When we were talking to Mark Gould at the Federal Reserve, we sort of asked him about like checks and other forms of payments and how real-time payments might sort of eat into checks or whatever. And the Fed's perspective, I think, is that, or I should say Mark's personal perspective, because he wasn't speaking on behalf of the Fed. But, Mark's perspective was that none of us are speaking on behalf of our employers, just to be clear. His perspective seemed to be that, like, as long as there was one person who wanted to write a check, it was the Fed's responsibility to help process that payment, essentially. And that, like, there was going to be no sunsetting of payment methods. And that it's not the place of, like, infrastructure providers to sort of make value judgments, if you will, on, like, which payment method is better than another. And I thought that was pretty interesting because, like, you contrast like checks with like cash. Like cash has a different set of values, right? Like cash can be a store of value. Cash is anonymous. Like there's a set of things that cash has that are very unique attributes that just no other form of payment has. Checks, though, to your point, like, yes, they avoid processing fees for electronic payments. But when we move, again, going back to account payments, when we move more over to account payments, I mean, I would think that we could eat into a ton of volume for checks with account-to-account payments. And, if it's moving in real time using RTP or FedNow, we don't have to suffer the delay of, checks having to wait to clear. Mark made that point very strongly that, like, speed can actually remove the opportunity for fraud because you don't have fraudsters playing games with, like, check clearance windows. And, like, that's how a lot of check fraud works is, sort of counting on the float and the settlement windows. So, I think there are rails and mechanisms we have in place that could solve this, but you do need to drive people over to other forms of payments and get them to stop using checks. And, I'll speak as a white person briefly. I mean,
could you just represent the check?
I'll do my best. Yeah. I mean, when you were describing the things that people still write checks for, I was like, yep, that sounds right. I mean, it's a lot of writing checks to contractors. It's a lot of, I guess what I'd say is it's a lot of areas where like software and digitization haven't quite taken hold yet, right? Like my contractor that I work with right now on this project, he's in his 70s, he like lost his phone the other day for like a few weeks and just was like, I don't know where it is, so paying him via electronic payments would have been challenging. But I do think, and this harkens back to something we've talked about in other podcasts, I know you're a capitalist through and through, and I'm like secretly a socialist. But I will say that like one of the things I find in other countries, and you referenced like South Korea as another example of this, there are other places in the world where the government or the government agencies that are responsible for like financial services infrastructure, they play a more active role in like driving consumer adoption of these different services. And I do think to a degree that's how you get to the long tail of this stuff, right? Where it's like, hey, this contractor who works in Montana and who's not particularly sort of savvy about, different fintech apps and Zelle and whatever, like you need to kind of get to this person a different way. And I think there is that kind of long tail. And if you don't put the full court press on them, and I will say in defense of the Fed, they had a booth at Money 2020 and were actively like selling Fed Now. So they're out there selling, to their credit. But, I think it's one of those challenges where if you don't do that, what you end up with is this infrastructure that is not used enough to have like volume and like protections and, like all of the sort of things we have in place. We were just talking about debit cards, like fraud costs have come down because we've gotten really good at like apparently reducing the costs of fraud in card rails. The more people who leave checks, the more it's just sort of this barren wasteland where bad behavior can happen and not get caught. And I to your point, I really feel bad for the banks too, right? Because it's like they still have to honor checks. They still have to accept checks. But I'm sure they've retasked a lot of their internal priorities to higher volume payment rails. And so checks is like this sort of open avenue for attack that you still have to have open, but you can't dedicate the same resources to. So I don't know. I mean, I'm kind of coming around to the idea that maybe there should be slightly more of a forced sunsetting of certain things. Like it kind of reminds me of when we moved over from magstripe cards to chip and pin on credit cards and debit cards in the US. Like the switch to EMV, and like merchants and others like howled about that and were so mad about it. But the reality is the incentives that the card networks put in place to drive that switch, we switched, it all worked. No one is like, bent out of shape about it now. And the reality is we basically retired a more vulnerable form of payment where fraud can happen more easily. It's gone now. Like that magstripe fraud is not a thing anymore because we solved it. I kind of think checks deserve the same kind of scrutiny.
Yeah, that's really interesting. Also, I don't write checks very often, but I get paid in checks a lot in the mail.
Yeah, sure. I get a lot of checks.
And I have become so concerned. And like as a soccer referee, you actually have to kind of like, you have to maintain like a list of the games you've done and have you gotten paid for them. And I've been so worried that I'm going to have a stolen check in the mail and I'm going to just be like, this check never showed up. When did you issue it to me? And like thinking about that, and it has actually kind of made me feel a little bit less secure about that. And then I'm more partial to, I'm on like 4 different assigning platforms, and some of them do the, like you can pay my account on the assigning platform and then I can disperse it to my bank. And it is kind of a pain to like maintain, my bank details on all these different websites. But it feels now a lot more secure, and I get my money faster too because they disperse it a lot closer and then I receive it. And so it's just been funny to be like, man, what do I have to do to get these soccer assigners to stop cutting me checks and get on these payment platforms? So how many checks have referees reported stolen? So I would also love this forced migration. And I also don't know, kind of what, like, is there a way that you could like make it more expensive to issue a check, right? Like it feels like checks are very free in a way that like sometimes like sending money isn't free. And I wonder, is there some sort of design here or, I don't know, like with RDC, because I remember they wanted to make RDC like expensive when it first came out. I wonder if there's a way that you can put in controls that you would only do it if it's legit, or I don't know, like maybe the criminals will pay like $5 to deposit a bad check remotely. So.
Yeah, no, I think that's good. I think that's an interesting point. I mean, I think that the only other thing I'll say on that front is, and not to go too conspiracy corner on you here, but I do think that there is these sort of like kind of hidden incentives that we don't always see that affect these things, right? So like just as an example, the big core providers make a lot of money helping banks process check payments. I just, from folks I've talked to who've sort of seen this up close, like that's a big revenue driver. Kind of, again, to your point about like, how many checks were processed last year? Like, we don't think about it, but obviously all those checks are going through systems and getting processed. And so there are companies that benefit from that. It's not just the Fed, going, we'll support whoever's there.
Yeah, someone has an interest.
So there is like an embedded
still.
Interest in checks. And like when I look at, again, referencing RTP and Fed Now, like the problem with those networks is no banks are signed up as senders, right? So a lot of them are signed up to receive real-time payments, but none of them are signed up for sending. I was talking to someone about like why that is. And one of the things they were saying that I thought was really interesting was they're like, it's actually kind of hard for banks to sign up for it because you have to go through like a technology platform in order to get it, right? Yeah, you have to use some platform to get access to this functionality. And particularly if you're a smaller bank, you're not going to build that technology yourself. You're going to go through the cores. And the cores aren't offering a lot of send functionality or send use cases on faster payment rails yet. They have it on their roadmap. They're going to get to it. But yeah, the conspiracy part of my brain is like, maybe they kind of want to drag that out, keep this sweet check revenue coming in because, like, I think you would lose money if you were to switch over to these faster payment rails because they are really cheap. They would be safer. And so there is always someone who loses when we make these transitions. And I think from a public policy perspective, it would be nice for regulators to think about, like, someone has to lose, but who do we want to lose and who do we want to win?
Yeah.
All right. Should we do a little wait, but why?
Yeah. So I think
I have a good one for you. I have a good one for you. I know normally you ask me the wait, but why, but I'm going to flip this around on you today. So you sent me an article that was talking about the sort of sentiment from kind of like a stock market perspective on sort of tech-focused banks and sort of like what it means to be a tech-focused bank and trying to sort of parse out like, well, how does the market treat tech-focused banks? And do they have higher valuation levels? Are they valued more by the market than others? And the point of the article was just that it's kind of nuanced because there will be sort of crypto-focused banks, for example, that are really struggling. And then there'll be other sort of tech-focused banks that have a particular focus on a different product category, like payments, as an example, and like facilitating payments where it's like, wow, these banks are doing really well, and the market seems to really value them, and it seems to sort of take the fact that they are these tech-enabled platforms for facilitating payments, like they view that as a good business model, and one maybe that's a little durable in sort of changing macroeconomic environments. So I read this article, and the thought that occurred to me was, I have a really hard time parsing out a couple different factors and how they overlap, okay? So on the one hand, are you a bank or are you a fintech company? And then depending on if you're a bank or a fintech company, what particular vertical you're in, what area of financial services you specialize in, and then how does the stock market sort of value the combination of tech, financial services, and whatever that specific vertical is. And using payments as an example, this article was kind of talking a little bit about the fact that some of these banks that are really sort of deep into the payments facilitation space, really good business, durable in different models, valued by the market, seen as sort of, I think, a good hedge against some of the sort of macroeconomic conditions that are dragging down earnings for other banks. And yet, Kiah Haslett, fintech companies like Adyen, for example, that do payments and that only do payments are absolutely getting hammered right now by the stock market. And they're just like, they're having these massive sell-offs. Their valuations are getting like literally like cut in half. And yet they're both in the same business. And so I'm trying to sort of understand, like, was Adyen and other sort of peers of it just overpriced relative to everyone else in the payment space, including banks? And this is bringing their valuation down more in line with that. Is there some sort of inherent advantage to being both a bank and a tech-focused company working in payments? Why does this apply to certain verticals like payments, but not other areas like, I don't think tech-enabled lenders particularly get a valuation bump over sort of non-tech-enabled lenders. So, like, what is this sort of confluence of being sort of tech-forward, working in a specific vertical, and either having a bank charter or not?
Yeah, that's so funny. Okay, there's a lot of questions there, and I did not expect these questions when I sent you that article. So
I spun it in a totally different direction.
We went in a completely different direction. That's really interesting. As someone who focuses on banks and doesn't actually really focus on valuation or stocks.
And I don't either, just to be clear. Like, I am not an expert in this, which is why I have this question.
Right. And, the other thing, too, about banks is public banks tend to be valued on a price to tangible book value basis, as much as they would love to be valued on their earnings, their price to earnings, whereas that price to tangible book valuation is not available to tech companies.
That's right.
Am I right? They are valued on future earnings and often
vibes.
What's hot. And so, I think if you are thinking about
Adyen,
is it Adyen? Adyen's valuation, and you're saying, well, it's halved from what period of time? Are we talking about from its peak and then it's at halved? And do we think it was potentially overvalued and now it's maybe correctly valued? Do we think it was appropriately valued at its peak and now it's undervalued? And the other thing too is like, if you theoretically the stock price is supposed to be like what, like a discounted forward-looking earnings, which is not how anyone thinks about stock price. That if they are making less money on their core one business that they have, then yes, that should be reflected that they have a decreased earnings outlook. I think one thing that's really interesting about banks who play in the tech space is that, having that magical bank charter, often provides you with a series of privileges and a different potential funding structure. Whether or not that's working out to banks' advantage or not, it is still really, really different than the funding structure that is available to tech companies that don't have a bank charter, or especially consumer lenders that don't have a bank charter, right? Because you don't get that super cheap funding. I think something that's really interesting about tech-forward banks that might be enjoying a higher valuation, one, banks aren't like crushing the stock market right now. Like it's like the investors are not hot on banks right now. And they are not hot on banks because of reasons that are really specific to being a bank, which includes, liability. Many banks are currently liability sensitive and they are getting crushed by higher rates. But the banks that are tech banks that are doing really well, they are asset sensitive, like I've talked to you about the Bancorp. And so the Bancorp is able to have a more predictable beta. Their assets are repricing really quickly. So, maybe the sentiment isn't really about their non-interest income through payments, or that's just kind of icing on the cake, but the cake itself is still really, really good. And so I've just been thinking a lot, like when we talk about, I think what's interesting is you kind of see these companies being the same, and then you're curious about the difference. But I think in the rising rate environment and what it's doing to different business models and, how ZIRP, the loss of ZIRP impacts business models, why no one wants to use this one payments company and they want to use other payments companies. It's not like payments are going away. So it's like probably more company specific, but that the differentiated business model of having the bank charter plus having the tech capabilities or ostensibly being asset sensitive and capitalizing from higher rates is a benefit. And you can kind of see this delineation between banks and fintechs that might be doing things that are kind of similar to these tech banks.
I think that's right. I think that it's one of those situations where like two things can be true at the same time, right? So it's like, the human mind struggles with this, as we've seen in a number of different contexts recently. But like, I think that's kind of the issue that I come back with is like, when you look at like Adyen and some of the other sort of payments focused fintech companies that have just been getting hammered, I think investors are saying, you're not worth what we thought you were worth before. But it's easy to sort of see that and go, oh, well, does that mean that like payments isn't like a good business? And then on the bank side, you have investors looking at these banks that have kind of turned into more of like kind of transactional businesses, right? Like we're not going to hold any assets. We're not going to like really worry about like sort of managing like liability risk. Like we're just going to be a machine and we're going to churn through all of these different transactions and collect fees along the way. Payments being probably the best example of a business model that lends itself to that. And we're going to build the technology necessary to sort of get involved in that business. And I think bank investors look at that and go, this is amazing. And I think the reality is, they're both kind of saying the same thing, which is payments is an amazing business. Payments is a growing business.
Right.
Payments is a space where you can build a very sort of asset light, high revenue, predictable sort of money-making machine. The difference is solely just that banks have historically been held down in their earnings because of the way that their value's been looked at. And we just went through this psychotic era of fintech super valuations where, and I think I wrote about this when Adyen had this problem this one day, was a month and a half ago, where their earnings just got slammed. Like, I actually think that they're still a really strong business. It's just that the stock market is kind of weird and they had to sort of reprice themselves. And so I think it's probably less of a delta between these things than we think, but it is really interesting to watch bank business models and fintech business models collide in a strange way, because I think fintech companies are sort of coming around to the fact that like, wow, there's some things about being a bank that look really nice from a business model perspective. And I think at the same time, banks are looking at some fintech business models and going, wow, that transactional model where you can just sort of collect fees, like that looks pretty nice. And so there's sort of this kind of slow merging together of business models, and the stock market, I think, is the one caught in the middle going like, how are we supposed to value these companies? Like, is it a bank? Is it a technology company? Like, what's their durable advantage? What's the structure of their, kind of existing margin? How can they expand that over time? Like, all of those questions that you used to have very clear answers to as a stock market analyst, because like, I'm looking at a bank, this is how I value it. I feel like those are kind of what's being challenged, and that's why there's these weird sort of ups and downs right now with these specific companies.
Yeah. I mean, I've previously established I just don't understand how fintechs are valued, especially when they're not really making money. The other thing too, and this is kind of related, but not directly to your point, is I've been very curious this year how bank stock prices translate, if at all, to depositor sentiment. Because, for, the spring banking stress, we were seeing, the SVB free fall, and then we saw like PacWest, right? So we saw PacWest have a stock sell-off. And it wasn't clear how that translated into deposit runoff, because they don't necessarily, like, the depositors of a bank are not necessarily the shareholders of the bank, and it is not really clear what, if all, like, that would translate, especially like the stock price to deposit runoff, not deposit runoff to stock price. And so to think about, like, with the revaluation of some of these things, like how does sentiment like influence, if at all, a business model or results, right? Like, I sometimes think in banking, like they're actually just kind of divorced, or they're not, for me as someone who doesn't invest in banks directly, they're just not as relevant. I care more about kind of how much money a bank made, not necessarily did its stock price go up a lot and what does it mean for its valuation. I really only think about valuations with deals. So that was like, well, the mystery continues for me.
I agree.
Yeah.
It really is. And I think, one thing you said there at the end that I'll put a final point on is there is something very healthy about just not looking at stock prices, honestly. And I kind of feel like, and you've gotten into this problem with like the SoFi bros on Twitter, right? Like, there is a population of people. I know, sorry, if we say it 2 more times, they'll like appear behind you.
Oh my God!
I'm sorry. No, I won't mention this on Twitter. I promise. Kiah hates #SoFi. No, I mean,
I am a user of SoFi. Like, I don't even understand how I came to be in their ire. I got mad.
So mad.
But yes. Okay, go say what you're going to say about the SoFi, because they're so specific about the stock price, right?
That's the thing I notice on Twitter, just as one example of a broader trend, which is like, people care way too much about what stock prices are doing or where they are. And so it's like, SoFi's up, we're all millionaires, this is great, or SoFi's down, but I'm holding, and here's why you're a moron for not, and blah, blah, blah. And the reality is, having worked at a bunch of these businesses, including ones that are public companies, they don't know what's going on. Like the company is just trying to run its business, create value for customers, and then every quarter be able to tell a reasonably not scary story to shareholders so they don't all just flee for the exits, right? And sometimes you screw that up, or sometimes you just don't have a good story to tell and you have a really bad quarter and your stock price goes down. But like, it's so divorced from the fundamentals of how these businesses work that when you said like, I don't really look at stock prices unless it's a deal, I just look at like the actual earnings of the bank, like those SoFi bros would be so much better off just never being able to see the stock price and just having to analyze the fundamentals of the business, because I don't think they do that at all.
Speaking of also banks that need to be on this list, I don't think SoFi is in this like bank tech list, and I think they're one of the most interesting, like, because they also don't really report their earnings as a bank. So maybe we need to maybe like after they report earnings, maybe for the December show, we'll talk about how what does SoFi identify as, and how should they be valued, and why don't they just report net interest income like every other normal
that does
bank?
sound like a very good way to rant about. So to end the show, Kiah, and listeners, in the interest of not having a conversation that goes on for the next 40 minutes, because we have much more on our outline that we could talk about.
We've tried. We really tried.
We're trying to keep it punchy. So the last thing we're going to talk about is our new favorite segment, Go Off Kiah, where I ask Kiah to go find some story out there that just fascinates her or that she wants to just sort of rant about for a second. And you always find the best stories. So I know you have one or maybe a couple that are linked by a theme. Okay.
Yeah, I'll summarize them really quickly. So in the spirit of vintage payment methods, there have been some hilarious, incredibly amusing stories about how coins are
coins
annoying.
like quarters and dimes and pennies and
coinage.
Yeah. Not like, we're not talking
change.
like tokens or like
cash currency, but smaller than the cash.
Yeah.
Oh yeah, I'm sorry. We're never talking about crypto. Just to be clear, when I talk about coins,
with that
I'm never
disclaimer out of the way.
Crypto.
So stories about coins.
Coins. So the first one is that probably my favorite crime story of 2023 is that 4 men stole 2 million dimes worth about $230,000 from a truck that was making a delivery from a federal mint to a regional reserve bank. They were only able to launder 5,200 of these dimes before being caught using various Coinstar machines up and down the East Coast and apparently 4 different banks in the suburban Philadelphia area. And then the second one is that, there's been some payment disputes, like petty payment disputes. And this most recent one is that a Colorado judge ruled that the more than 6,500 pounds of loose change was not considered a proper form of payment for a defendant to pay off like a $23,000 settlement in a legal dispute.
It wasn't reasonable.
The judge said that this does not count as way to legally settle this dispute, even if it is legal tender. Apparently, the defendant had taken coins that were neatly organized and then dumped them loosely and randomly into a metal container. In the order, the judge said that while coins are technically legal tender, paying such a large amount in coins would reduce the settlement because of the time and expense required to accept it. And I just think that this is kind of a really interesting, these two things kind of speak to an interesting thing and I don't even want to say banking because this is kind of outside of banks, but in the form of money, which banks often deal with, and that, coins are seen as kind of a burden. They are, you can't launder 2 million coins expeditiously. And that's probably why we don't see when someone steals $2 million, they don't do it in the form of dimes. And then that also, people understand coins to be annoying to deal with, annoying to store, heavy. They understand that we don't really have ways to sort coinage efficiently. I don't know if in $23,000 in coins would have ever been efficiently and seriously taken as payment, but certainly in 2023, it's not. And it's really interesting to think about the role that, if we're talking about checks, and at least checks serve a purpose of large payments to contractors, coins are really not serving that purpose. They kind of serve this purpose of exact change, but for very specific small amounts. And we kind of just assume coins will be used in certain ways, and we won't. And actually we are now saying they will not be allowed to be used in other ways. And, I don't know if you remember the other time I was thinking about coins was during the early stages of the pandemic. There was a coin shortage because there was an interruption in circulation. So it was really it's been fun to think about the role that coins play in payments infrastructure, and that where, when we talk about the Federal Reserve is committed to cashing the last check, and what is the U.S. Mint doing over here, right? 2 million dimes were stolen. You were transporting $700,000 in dimes, which also that's too many dimes. Who around the country need my dimes. Get us the dimes, Fed. I know. And so I've been fascinated by these this subgenre of coin journalism and coin shenanigans. Yes. And so I wanted to put that on your radar. Did you have an emotional reaction? Do you have any jokes you want to make about the coins? I had a huge emotional
reaction to it. Well, first of all, the episode title, Coin Shenanigans. So to our friends who are editing this, that's that. Yeah,
never cryptocurrency.
It's always just coin shenanigans. Yeah, I mean, if I tried to pay my contractor in coins and dimes, he would burn my house to the ground, right? So that is a deeply petty thing to do. I'm just fascinated by the person who tried to pay with 6,000 pounds of loose coinage. That's insane. The amount of that's
they tried to deliver them too. They went all the way.
I'm glad the judge ruled that, right? Because that's
wild.
That's
they
just
were really committed.
That is really antisocial behavior dressed up as technically this is legal tender. You're no, don't be a dick. This is not cool. So that I think the judge came down on the right side there. I will never not think about people robbing 2 million dimes off of a truck. Did you ever see, so in Groundhog's Day, the movie, when he's deciding he can do whatever he wants. Have you ever seen Groundhog's Day? What? What?
No, I'm sorry. I'll just
No.
Until you directly asked, I was just gonna pretend. I was gonna be like,
This is terrible.
Oh, yeah,
okay,
I love that scene.
All right. So everyone who's listening, like, spam Kiah's like email, LinkedIn, Twitter, and tell her like this is totally unacceptable. All right, we'll solve this problem offline, and we'll.
Okay,
the only scene, now it's like not even relevant, but like the scene that is he goes and he decides to do a bad thing, and he steals a couple bags of, I think, like coins, like quarters or something, off of this truck, and then he like spends the next day like rich because he has all these coins. But the part in that they don't show is like, what's the practical ability to like translate all of these coins you have? Like, where did these guys even store all the dimes? And like,
apparently there is video of them stealing recycling bins.
Amazing.
And they were like, after they stole, like, because they just break into these trucks that are making these like long haul deliveries, and they were stealing like shrimp, and like they stole a bunch of like tequila, and they stole appliances, which I think honestly I think those are easier to launder in traffic than dimes, right? You'd have to sell these dimes, and you'd have to give a discount. Like, how much money would I pay for $100 in dimes?
Well,
probably $20. Right? Like, that's how they'd have to do it.
And I love this idea for like a thief or like a fraudster would be like, I'm just going to cash in $1 for the next 40 years in dime. You know, like such a small amount. You see, you get like an annuity in stolen dimes every week. But like the point of crime, is like to like be able to live large and enjoy the spoils of your theft. Like the point of crime is not to like line your pocket with $10 extra of dimes every week. That's not going to work, you know? And so like, I mean, it's such an impractical thing. The only thing I'll say about this is coins are really useful for teaching like counting and money to kids, I'm finding. And my son got into a fight with a friend that he had made at school, and he's like, I'm not friends with him anymore. I'm like, oh, okay, you know, like kid stuff, like whatever. And he wouldn't really tell me what had happened. And then the next day he was like, yeah, we're friends again. And I'm like, why? And he's like, he brought me a quarter, and he showed me the quarter that his friend had brought him, and he's like, do we have a quarter that I can give to my friend? And I'm like, yeah, I'm sure that we do. And I had to like rummage through some stuff to find a quarter because we don't even have that much coins at our house. So they do... we do, but the piggy banks are sort of a pain to liberate the coins from, and so they're more decorative. They're not designed to be broken into.
Can we just really? I mean, I get it, but I'm sad and I'm annoyed. Banks used to offer coin counting for free, and it was like a benefit. You would just walk in with your piggy bank or like your sack, and then they had a machine. And have you done this recently? Because they don't have the coin counting machine anymore. There are some banks that if they don't specify that a branch has a coin counting machine, the only way you can deposit a lot of coins is come in with them pre-rolled. So you have to sit your butt at your house in front of the TV or something or some podcasts and roll your own dang coins and bring them in. And I'm just like, this is a real step back. And I was actually like kind of shocked because, you know, like, I don't know, like your parents or you ever did like the coin jar and then like like for Christmas you would cash that in. Well, now it is a little chore for you to do. You got to do a chore before you get your $20.
It's crazy.
Or $100 from the bank. And you have to go change your money into other money so then you can go use that money because you're probably not taking like a roll of quarters.
So have you ever been behind someone who's tried to do that, like in line? I've gotten behind people in line a couple of times who've tried to pay with like change, and it's like, you know, that'll be $26, and they try to pay in quarters and dimes and shit, and they're like pulling it out of like their thing. So one other thing on this, I didn't think it really is.
This is like the song Christmas Shoes.
No, it really is.
Remember? And you're behind that person instead of like buying the
you're like,
shoes. You're like,
oh my God, the other thing though that's funny about this is, and we should do a whole coin episode in the future, but in Japan, their currency is way heavier on coins. So they have higher denomination coins, right? So they have like $10 coin. Yeah,
like a $10.
I can't remember what the currency is. They have like
is.
a $10 version. They've got like a $5 version. So they have like coins are real money. And so when I went over to visit my wife's parents, we went over to visit them in Japan. We went out and we were like going to the store and we were like, oh, this will be fun. Can I go do this? Yen, that's what they have. And we'd go to this store and they're like, yeah, you know, here's some money. And they handed us like a coin purse. And they had multiple coin purses, like at their house, like Like they were like, "Oh, Alex,
just,
you probably
like-
don't
like-
have a coin purse with
Oh
you."
my
I'm like,
God.
"No, I didn't pack a
you didn't
coin
bring your
purse."
coin
Yeah, and they're
purse
like,
from
"Oh, okay, you
America."
can borrow ours." And I legitimately
Yeah.
had like $50 in coins that were like in this coin purse, but I couldn't keep it in my wallet and I couldn't keep it in my pocket, so I had to have a coin purse
Obviously
with
not, yeah.
me when I was in Japan. So
Yeah.
I do think that there are
This is so
other
silly.
areas where coins make more sense, but like in the US, it's like too many dimes, man. Like that's you get buckets full of dimes
Too
and you walk
many
in, they're
dimes.
like, yeah, that's $20.
Yeah. I think I'd be okay
Right,
with
they're
coins
not,
if
though.
they like were money. And I think like these stories kind of show that like kind of coins kind of
They're not really money. Yeah, the denominations are too small. Pennies are useless.
Yeah.
Yeah.
Right. Well, and we still make them, and sometimes
I
it
know,
costs
I
more
know.
than a penny
That's
to make.
lunacy. Okay,
a penny,
well,
though.
this was a good one. I appreciate this rant. If anyone is needing to, roll their own coins at home, hopefully they'll listen to this podcast while they're rolling the coin so they can at least multitask a bit. Kiah, we'll be back at this next month, but until then, thank you for the time. This was awesome.
All right. Well, thanks so much. Looking forward to it.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.